Hello, and on this episode of the Mortgage and Protection Podcast, we have Paul here from Henchurch Lane to explain how limited company mortgages work. It's great to chat with you as always, Paul. Thank you for joining us.
Thank you, Tessa. How are you today?
I'm really well, thank you. How are you?
Good. Yes, very good. Great day all round. Thank you for asking.
Good, I'm very glad. Well, let's get straight into the questions that we've got here. So, first of all, then, how does the mortgage process work for limited company purchases?
Okay, so it's very similar to a standard purchase, sorry, on the face of it. You're going to need to apply for a mortgage and you're going to need to instruct a solicitor to carry out the legal works for that purchase. The main difference being that the property that's going to be purchased will be owned by the limited company, which is a separate entity, and it will be taxed accordingly rather than it being owned in your personal names and taxed to you personally.
Mm.
So these kind of cases are a little bit more complex. So you're unlikely to be approaching, say, high street lenders to place this sort of business. It's going to be maybe people that are off the high street, people you may not have heard of, that are more specialist in that sort of space. But yeah, the main difference being that it's purchased within a limited company, which is effectively a tax vehicle or a tax wrapper, some people refer to it as. But the process itself is very similar.
Right, okay. Well, that's good news and really clearly explained there. And with all that in mind, then, the next question asks, are there any specific mortgage products designed for limited company purchases?
Yes. Yeah, so most lenders who are going to offer purchases via a limited company will have a specific range of products that are specified for limited companies. They'll usually be priced slightly differently. So from a rate perspective and from fees and costs and things like that, they all tend to differ. And there's reasons behind that, but it's not going to be like you can go out and just get a personal standard residential rate on these limited company products. There'll be a specific product set for those for you, okay?
Right, okay. So that's clear there as well. And again, you've kind of touched on it there, but do many lenders offer mortgages for limited company purchases?
Yeah, so on the last count, we have somewhere between 40 and 50 lenders that will offer limited company mortgages. Now, does that then define many lenders? It's probably about roughly half the lenders that we have access to. So generally speaking, if you're whole of market and you've got access to, the entire market, then it's going to be knocking on around about 100 lenders that we could place business with. Obviously, we don't place business with that many lenders. There'll be maybe a quarter of those that the majority of the business goes with. But limited company certainly does limit your options, but there's still plenty out there to make sure you can achieve your goals.
Okay, so again, that's good news there, positive news. Hopefully, that sounds reassuring. So let's move on to this question, just to go into a little bit more detail now. What are the eligibility criteria for obtaining a mortgage via a limited company?
Okay, so if you're purchasing a property via a limited company, it's usually going to be through something called an SPV, which is a special purpose vehicle. And what I referred to earlier on, which is opening the company. It's simply a limited company that's created for the purpose of buying, renting, and selling property. So it's not normally a trading business like a typical limited company that you'll work for. It's effectively a tax vehicle or a tax wrapper, like I said, that some people refer to it as. So if you wanted to buy a property via a limited company, you're going to have to set it up. So the first thing you're going to need to do is go onto HMRC and actually create a limited company for that purpose.
Mm.
So that's one thing that you've got to bear in mind. A lot of the times we do these limited company purchases and people are very keen on buying them in a limited company. And when we go to the application stage, we'll ask them what the name of the limited company is, and they haven't created it yet. They've got this big idea in their mind about what it's going to be called,
Mm.
but actually they haven't gone on to HMRC and created it. So that's the first port of call. You're going to need to do that. It takes about 15 minutes to run through the application on HMRC. So once you've got that, you can then obviously go ahead and start instructing applications through that process. You usually need to put a director's guarantee in place. So although it's a property that's bought with inside a limited company, the directors are still going to be personally liable for any kind of defaults or anything like that. So don't think you can just go and buy a property in a limited company and get away with not paying your mortgage. You'll be the one that's personally liable for it. You're usually going to need a 25% deposit, maybe some experience as a landlord, although that's not always For every lender, it's not always a deal breaker. So we can find you deals if you haven't got experience as a landlord.
Mm.
And then all your usual criteria that's normally included in applications. So things like loan to values, property types, ages, maximum loans, etc. All of those sorts of things are going to vary from lender to lender, really.
Okay, so lots of useful points there and to take away from the episode. Let's move on to this question. It follows on really. What documents are typically required when purchasing a property via a limited company?
Okay. So starting with personal documents, you're going to need your usual 3 months pay slips, corresponding bank statements, your ID, so driving license, passport. You'll need a proof of deposit. If you're self-employed, you're going to need to see your latest SA 302s, also known as tax calculations, the corresponding tax year overview documents for that. If you're a limited company director, so you've actually got a trading limited company that you operate from in the background, you're going to need your latest sets of company accounts and probably bank statements from that company as well. With regards specifically to the property or the application itself,
Hmm.
depending on what lender you go to and depending on how many properties you've got in the background, they may well ask you for like a business or a cash flow projection or even a property schedule to note down all of the details about the background properties because effectively you're going to be looked at as a bit more like a business in itself if you've got multiple properties in that limited company in the background.
Okay, well, thank you for the breakdown there. Preparation is key. We always say that, don't we, when it comes
Yeah,
to the
that's
documents?
obviously an excessive list, right? So that's the longest list of documents you're going to get is through a limited company purchase.
Mm,
But probably what we'll come on to later on is the fact that it is worth it. There is a lot more administration involved.
mm.
If you was to buy, let's say, a personal residential property in your own name, you might well be looking at something as easy as bank statements, pay slips, and ID. So you can see the list is a fair bit longer, but
Mm.
by that point, you kind of are looking to operate a business or property business to some degree.
Right, okay. Well, there we go. Let's move on to this question then. So, can I still get a mortgage via a limited company if there hasn't been much trading history?
Okay, so as I touched on earlier on, if you're buying a property via a limited company, it's usually going to involve the setup of the SPV, the special purpose vehicle. So because it's a tax wrapper, because it's for the purpose of buying property, it wouldn't really matter if it was created last week. You can still apply for a limited company mortgage. It's it's effectively just a vehicle to buy that. It's not a trading business as such. And that's where people get confused with it. You can buy property in a trading company, but actually it's not advisable normally. Speak to a tax advisor. Uh, but if you're planning on buying purchasing a property for a limited company, essentially once you've set that up, if you then apply for a mortgage the next day, as long as it's been set up correctly with the right SIC codes, SIC, for the purpose of that business, then you are all set. So if you're thinking about it, get on HMRC and set a company up. It's going to cost you 15 quid. Doesn't matter if you do it tomorrow or you do it in a couple of years' time. As long as you've got that, then you've got the first box ticked.
Okay, brilliant. Well, there we go. Key pointer there. Just to summarise what you've said already, really, just for the listeners, the watchers' benefit, are there any advantages or disadvantages to getting a mortgage via a limited company rather than in a personal name? So, what are we looking at here? Pros and cons.
Okay. This is a really long list. So let's start with the biggest ones, right? If you buy a property in your personal name, there's a good chance then that the rental income that you earn from that could potentially take you into the high rate tax bracket. So let's say you earn £1,000 a month or £12,000 a year on the rental income. If you pop that on top of your salary on a personal basis, if you have to pay 40% of that to the tax man, that's going to be quite hefty, right?
Mm,
Now, in a limited company, the difference is whatever your interest payments are on that mortgage. So let's say you're getting £1,000 rent, but let's say £700 of that is interest to the mortgage lender. They're only looking at the extra £300 a month as the profit. So over the year, you've only earned £3,600 profit, and you're only going to get tax corporation tax on that, which is 19%, not 40%, which is the higher rate tax bracket. So
mm.
the tax bill compared to buying it in a personal name can be dramatically different and save you tens of thousands of pounds, even hundreds of thousands of pounds over the term of the mortgage. So it depends on everyone's particular circumstances as to whether or not or what the figures actually are on the day. But 9 times out of 10, especially if you've got more than one buy-to-let property, it's going to work out as a bit of a no-brainer from a tax perspective, at least, to buy it in a limited company versus in your personal name.
Mm,
Now, that is despite the fact that in a limited company, there is more administration. You've seen how exhaustive the list is.
mm,
The application process tends to take longer. There's a lot more scrutiny. Um, and it can feel like a lot of work in comparison to buying a personal property or buy to let in a personal name. However, you know, if if you're going to earn that much more money, is it worth that time investment? Probably. And that question really needs to be answered on a case by case basis. So it's very important to know. I'm not suggesting that it's for everybody,
mm.
but I'm certainly suggesting that you should be sitting down and crunching the numbers to see what the difference is.
Okay, so actually a key point there. It all depends on your circumstances. Now we've got one more question left, but we will be back with a part two, won't we? We've got more questions on this. So just to end this episode on then, are there any restrictions or limitations on the types of properties that can be purchased via a limited company?
Yes, there will be, but it's not because it's being bought through a limited company. So lenders are always going to have their own property criteria, and they're going to differ. One may say yes to a property that another would say no to.
Mm,
So you just need to be confident that you're choosing the correct lender for the property that you're buying. A couple of little things maybe you should look out for when you're buying property, or at least run by a broker if you're looking to commit to. Things like non-standard construction, so timber frames, thatched roofs, concrete builds, those sorts of things. High-rise flats. So normally they're going to come with potentially a cladding issue or other issues around the lender's criteria. Ex-local authority properties, if you're looking at those, make sure you're speaking to a broker. Leaseholds, things like short leases, properties above flats, anything that is, outside of the conventional, two up, two down, then it's probably worth running by a broker to make sure. In fact, every single mortgage application should be run by a broker actually, because you're
mm,
stabbing in the dark otherwise, unless you're speaking to someone that knows what they're talking about, in my opinion.
mm. Okay, well, there we go. Something to bear in mind there. So we've covered all of the main points, haven't we, for our part one episode? Have you got anything else to add? Any final thoughts?
I mean, we've added it a few times. I'll always say speak to a broker. If there is a case in fact that's more pointed than this, that I don't think there is actually. It really
Mm,
is probably as complex as it gets, I think, from a mortgage point of view. Looking at growing a portfolio, looking at the ways that you can best save money on tax. That's not tax avoidance or evasion. What's the bad one? It's not tax evasion. It's
nice.
mitigation.
Mm,
Spending less money on tax, right? So things
mm,
like that really do need to be discussed, not only with a broker, really. You need to be discussing things with a tax advisor, someone that specializes within property. Um, and you need to all be sitting down together and coming up with a strategy for how you can best make profit from that business rather than just going in blind. And like I say, it could well result in the conclusion being that it's better to buy it in your personal name.
mm,
But you won't know that outcome until you have that conversation with a qualified broker. Not only a qualified broker, but someone that's worked in that space for a pretty long time, because they are very complex cases.
mm. Okay, well, there we go. A key note to end on there. Thank you for that, Paul. Hopefully, that's proved useful to anybody listening to this, watching this, and we'll catch you on our part two episode.
Lovely. Thank you, Tessa. See you soon.